All right, we're going to talk about some of the original investment commentary and podcasts, and also the top research pieces that we highlighted on the Validea Guru Investor blog for the week of February 5th, 2021. And to start, I thought, Jack, maybe you could talk about your article on what is risk, and then talk about the different types of risk that you outlined in the article that investors need to be aware of.
Yeah, everybody wants to come up with a clear definition for risk. So risk is exactly X. And risk is such an ambiguous concept that you can't do that. I mean, those of us that are quants want to say, all right, standard deviation is risk, or some other quantitative measure we can come up with is risk. But the reality is risk is in the eye of the beholder. The reality is risk is really about what will cause any individual investor to make a mistake, or what will cause them to deviate from their plan, or what will cause them to sell out at the wrong time. And so what I wanted to do is look at some things, understanding that risk can't be measured, understanding that there's no true way to define risk. I wanted to look at some things that potentially could be defined as risk for investors. And so I came up with 5 major ones, and although it's certainly not an all-encompassing list. One was permanent loss of capital, which basically means if you lose all your money, or you lose so much of your money that you can't come back and achieve your financial goals, then obviously you've experienced a huge risk. And so it's important to maybe develop strategies that prevent that possibility, not throwing all your money in options like people are right now. Obviously, if you put all your money in GameStop options, after the peak, you've pretty much lost all your money. Not putting too much in any individual stock. Or risk could be measured as volatility. So I talked about standard deviation. Standard deviation is one way to measure risk. And the reason, Buffett would say volatility is not risk, but the reason volatility is risk for many people is volatility is what leads people to make mistakes. So if I'm experiencing volatility, that means I'm experiencing drawdowns in my portfolio, or that means I'm experiencing periods of underperformance. And when I experience those periods, if I'm like Buffett and I do nothing, then it's not risk. It doesn't make any change to my long-term goals. But if I'm not Buffett and I panic, like most people will, then volatility becomes risk through my actions. And then the third one was deviating from the market. So if you're not an index investor and you try to follow a strategy that substantially will deviate from the market, whether it be a long only strategy like value that can underperform for a long period of time, or something like trend following that will take you in and out of the market, when you're doing poorly and the people around you are doing well, again, you're typically going to make a mistake, and that can, risk can reflect itself that way. And then the last two, the fourth was investment strategy risk. So there's obviously the risk if I follow any investment strategy that even if I follow it over the long term, it's not going to work. So although we're believers in value investing, there's some people who believe, if you follow a value strategy, that outperformance that's been there in the past won't be there in the future. So if I follow value, I'm taking that risk. And then the final one was bad luck. So a lot of people, if you think about it, if I retire tomorrow and a bear market starts tomorrow, I've experienced, I may have created the perfect investment plan, but I've still experienced risk. And that risk is what people call sequence risk, which is if I lose that much of my money right as I start drawing money out of my portfolio, it can be really hard for me to come back from that. So even if I've set up my portfolio perfectly, if I just get bad timing with a bear market, that can derail me. So sometimes bad luck can come in and show itself as risk.
Good. I think that's a good future podcast episode for us. We can use that as a baseline to work off of, so that'll be good.
Yeah, you could talk about risk all day. I mean, there's so much going on with risk, and it's so difficult to measure that. Yeah, I mean, we should talk about it because it's an important concept for investors to understand, but it's really hard to get your arms around it. What was our podcast this week?
So yeah, we had Jack Vogel from the firm Alpha Architect on. We talked to Jack about momentum investing. He sort of helped us and explained sort of what momentum investing is, how it can be measured, how it can be deployed in a investment strategy. I think some of the pluses and minuses with momentum investing. Jack is actually the co-author of the book, Quantitative Momentum. That was the first half of the podcast. And on the second half of the podcast, we talked about trend following, which is basically using something like a moving average to move in and out of an asset class, let's say. And we talked about what trend following is, and I guess some of the pluses and minuses of that. And we talked about how hard it's been since the great financial crisis to actually utilize a trend following system and get it right. And like Jack said, trend following can be a very good way to mitigate some of the risks that you were mentioning before, but it can also be one of the toughest strategies to follow because basically any trend following system, anything that's used something like the 200-day, let's say, to move in and out of stocks, has basically got every single, there hasn't been tons of signals, but it's almost got every signal wrong over the last 10 years, and that would have, hurt the investors' returns. And it doesn't mean the next 10 years are going to be that way, but, that's one of the things that sort of we talked about with Jack. So it was a good podcast. I think it's good. Jack's a great guy, and we hope you guys check it out.
Yeah, and one of the interesting things with me about momentum is, if you would hold all the investing factors and sort of rank them, you would find value and momentum are at the top of that ranking. They're probably pretty similar in terms of their long-term returns, but then if you would rank them based on how many people follow them, value's way up here and momentum's way down here. And so more people should follow momentum than do. And part of the reason they don't, I think, is because it's difficult to understand why it works. And Jack did a really good job of explaining why momentum works and why it might be a good long-term strategy for people to follow, and particularly to maybe couple with strategies like value when building a portfolio.
No, I'm glad you said that, because that's what I was going to say. I was going to say like a value and momentum sleeve. When value's not working, momentum should be picking up the pace. And when value sort of comes back, maybe you would be able to, benefit from that value reversion. So combining those different factors can be good, I think, in terms of a equity portfolio. What was the article that stood out to you the most that we highlighted?
We highlighted some insights from Bill Miller's Q4 letter, and I always like reading his letter. He's sort of very different than me in the way he views the market. So, I'm the type of person who's looking at the market right now and saying, wow, we're way overvalued. This can't keep going on. And obviously that doesn't reflect in the way I invest, but, I'm always believing, when we're at high levels like this, when we're at all-time highs and valuations are high, I'm always a big believer like the next correction is coming. But Bill sort of takes the other side of that. Bill looks at what's going on right now economically, and he doesn't really see any reason why this won't continue. I mean, he thinks we're in the early stages of a bull market. We're not anywhere near the bull market ending. If anything, he thought maybe the risk going forward is inflation might be higher than people think in the future. But in terms of where the market is right now, he doesn't see a lot of reason for pessimism or a lot of reason to believe we've got a big downturn coming.
Yeah, I think one of the things that I believe, highlighted in that letter, he was talking about how long he thought value stocks had. I mean, they've been performing better. So he was kind of estimating, he was saying, there's at least another year of values outperformance that he expects, I think, is still going to take place at the minimum. I mean, we know that these reversions can go on much longer than that, but for systematic value investors, that's certainly good news if that comes true.
Yeah, particularly because he's typically not a deep value investor. So the fact that he's, a fan of deep value right now, certainly makes me feel a little bit better about it. What was your article this week?
So it was an article from Bloomberg. The title was S&P 500 Profit Recession May End as Companies Trounce Earnings. And so basically what's happening is the companies that have reported so far in Q4 are basically blowing away Wall Street estimates. And this isn't uncommon, actually. A lot of times what happens in the market, especially when you go through these big downturns and recessions, are analysts get way too pessimistic about earnings expectations. So they bring down the expectations so much, and then what happens is a lot of times companies end up beating on those expectations. And companies are beating in a big way. Actually, they beat quite significantly in Q3, and Q4 they're, like I said, beating a lot as well. And I think the article pointed out that a lot of these companies really cut costs like really aggressively. Cutting costs, employees staying at home. So you had like a perfect setup, and maybe business isn't as bad in some cases. I mean, some industries, obviously like airlines or maybe like, a publicly traded restaurant chain, clearly those companies aren't the ones that are seeing their earnings come in above expectation, although they could. I mean, maybe even, Wall Street might have discounted those earnings too much. And so maybe those are some of the companies. It didn't really break it down on a sector level. It just kind of said that, that earnings are coming in better. And, it makes the market, it referenced something like, we could get back to, I don't know what it was, like 2019 total, above 2019 earnings on the S&P 500. And as you as that gains steam, it may not make the market look as expensive here. Like right now, the market's trading at 23 times forward forecasted earnings. So if earnings continue to come in better, that multiple is actually lower. and that's probably better for the overall market's valuation. I mean, the market does look pretty expensive here based on almost all metrics, but if profits come in better than expected, at least on a price to earnings sort of multiple level, maybe the market's not as expensive as people think. So it'll be interesting to see over the next few months how these earnings continue to come in.
Yeah, I've been surprised by it. I mean, I was somebody who was probably more pessimistic on what was going to happen with earnings than what actually have happened. But your point about cost cutting is important, because if companies really became a lot leaner during this process and demand didn't go down as much as we thought it would, obviously when COVID hit, we thought demand was going to go way down, and it certainly went down some, but it hasn't gone down as much. And then now you put that stimulus into the picture, and you've got demand that didn't go down that much. You've got stimulus coming in, and then you've got companies that are much leaner with cost cutting. I mean, you really could have what people like Jeremy Siegel have been talking about in terms of really, really strong earnings this year. And they could continue to beat expectations as we go through 2021.
Great. So we hope you guys found this quick summary and valuable. We'll see you next week.
Thank you.
If you'd like to keep up on the research, writing, and curation we're doing at Validea, please go to blog.validea.com to learn more and stay updated. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonneau. Thanks.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.